Listening to all of this market talk, you might be scratching your head as to what some of these buzzwords mean. Here to break down the jargon being tossed around on the street is Brian Sozzi, Chief Equity Strategist for NBG Productions and editor of the Decoding Wall Street newsletter. Brian, welcome to the program.
Thanks for having me.
We keep hearing about quantitative easing that's being done by central banks around the world to boost economies. What is it exactly? How does it work?
Well, the funny thing is, Jennifer, this was a term that we heard 4 or 5 years ago, so it essentially came out of the blue. What it basically means is the Federal Reserve comes in there and buys treasury holdings from the banks, injecting them with cash. One myth that needs to be debunked: there is no printing of money. It is essentially created electronically. Now, the main function with this is you're trying to keep rates low. It's unconventional because the Fed usually tries to keep rates low through their effective funds rate. This is another separate operation altogether.
All right, what about systemic risk? We hear about it a lot in the context of the financial crisis and the European debt crisis.
Well, in our little Decoded Wall Street universe, we like to tell our members that it's almost like a domino effect. You press on that first domino and they're all going to fall. Systemic risk essentially is one company that is so big or has financial policy wonks, like to call it, too big to fail. If that company does, it's because it's connected so much into the universe and how the universe operates and companies operate. That company does bad, other companies could do bad ultimately.
All right, you know, the employment situation in America is a huge problem. The Fed chairman appears to believe that it's mostly a cyclical problem. Other economists would argue, however, that it is a structural problem. What's the difference?
Cyclical employment tends to come back when the economy improves. And I always think about one of my family members who was an electrician. It's not that the job has changed itself. You're always going to know how to do work on electronics, work on buildings, but you may not be demand for those services. You'll get laid off. When the economy improves, you come back. Structural employment is when companies offer XYZ job, but the employee only has, Z skills. There's a skills mismatch in the employment place. For example, if you were a truck driver, maybe that position is no longer there. Maybe you're flipping burgers at McDonald's. That would be structural. There are differences between what the companies want and the skills that employees have. All
right, we've been talking a lot about investing in bonds. Let's talk about the importance of the coupon and the issuer.
Well, the coupon it's not just the percentage on a piece of debt that a company offers. It tells a lot of message. For example, if your coupon is 10%, you immediately have to think, hey, will that company pay me back? Will they be able to pay me back the interest payments? Will they be able to pay me back in whole? And I think issuer is very important too, in terms of trying to think about if you ultimately get those interest payments back and be paid back in full. Lower credit quality companies, there's a big risk to that.
All right, thanks so much for breaking it down for us, Brian. We'll see you soon.
Thank you.